Thank you, everyone, for joining us today. My name is Kirsten Loita. I'm a partner at Osage University Partners, and I lead up our university relations efforts. Today, I'm going to be moderating a discussion on valuations and term sheets, which is the third part of our funding and equity webinar series. I'm really pleased to be joined by two of our managing partners here at OUP, Marc Singer and Matt Cohen, and we're going to go to the next slide. Marc, can you go ahead and introduce yourself?
Hi, I'm Marc Singer. I'm a managing partner and a co-founder of OUP. I've been in the venture industry for 29 years at this point, and I run our tech investment practice, which is everything in the physical sciences world, from hardware to software to materials to climate technologies.
Hey, hi, everyone. I'm Matt Cohen. I'm also a managing partner here at OUP. I'm a scientist by training. I have a PhD in bioimmunology that I did at Penn and spent some time in strategy consulting at LEK. And then joined OUP about 10 years ago and co-managed the life science investment team with our partner, Bill Harrington.
Thank you. Thank you so much, Matt and Marc. We're really glad that you're here today, and we're glad that our audience is joining us for part 3 of our funding and equity webinar series. We'll go to the next slide. You can find parts 1 and 2 on our YouTube channel and also our partner portal, and we'll put those in the chat shortly. Part 4 will be presented in April on what to expect when working with VCs, and we'll send out registration notifications for that in early March. We'll also be covering cap tables and exits and payouts, as well as setting up your board later in 2023. So keep a lookout for notices on those particular webinars coming up in the coming months. So next slide. So first, we have a few administrative items before we get into the content of the webinar. The slides and a recording of this webinar will be available on OUP's partner portal, and the recording will also be available publicly via our YouTube channel. The partner portal is our online portal for tech transfer offices and researchers at our partner universities that is full of relevant tech transfer and startup content. Once you are in the portal, for which you need to register if you have not already done so, you'll find a downloadable presentation deck and the video link for this webinar on the webinars page, which is under our startup resources section. We do encourage you to ask questions throughout our webinar today. Please use the Q&A tool in the Zoom bar, wherever that is on your particular screen, to submit your questions. Please don't use the chat. It's much easier for us to be able to track the questions when you use the Q&A tool. We also received a number of questions beforehand, hopefully all of which we'll answer during the webinar today, or will be answered in other talks throughout this series. So next slide. A short intro on OUP for those who don't know us. We are a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising participation rights available through their licenses. As part of this partnership, the institutions share in our profits and receive programmatic support on tech transfer and academic startups, such as what we're watching today. OUP is now investing out of its 4th fund and has invested in over 130 different companies in all areas of deep science. Many of those companies have had successful exits, either through IPOs or merger and acquisition. And the next slide shows some of our portfolio companies and the breadth of areas we invest in. Can we go to the next slide? Great, thank you. So this just gives you an idea of the different areas that we've invested in. We're always happy to talk more about our model, so please feel free to reach out to us if you'd like to do so. We can go on to the next slide. So our agenda today is pretty simple. We're covering 2 areas in total: valuations of startup companies and term sheets for investments in startup companies. And Matt Cohen is going to take it away for us on the valuation section if we go to the next slide.
Great. Thanks, everyone, and for joining. Appreciate seeing so many folks here. Many names on the list here are folks I recognize. So thanks again for joining. So I'm going to talk about valuations and how VCs think about valuation, how we determine valuations, and some of the process involved in just getting to the right valuation for a startup. Also, at the end of this section, we'll talk a little bit about some of the valuation trends right now in both life science and tech for startups. But we will be having an upcoming webinar on financing trends in about a month, and we'll go much more deeply into that then. So we'll stay at a pretty high level today. So what's the definition of valuation? So it's simply the process of determining what the current value is for an asset or a company And there's a number of different techniques to do that. We'll talk about one of the main ones in great detail today. But before we get into that, we need to kind of define terms and some basic terms around valuation so that everyone's sort of on the same page. So the first two to really understand are the terms pre-money and post-money valuation. Pre-money is what's the value of a company before any investment dollars go in or any new investment dollars go in. Post-money is the valuation of a company plus the additional capital that's been invested. So we'll kind of go through we'll go through an example here and we'll answer some questions at the bottom. So our example here uses a made-up biotech company called BioStar Biotech. This is a newly formed company now, and they're looking to raise an $8 million seed round. The company has authorized 50 million shares, and they've allocated those shares between two co-founders, 50-50. So 25 million to one co-founder, 25 million to the other co-founder, and now each co-founder owns 50% of the business. They need to raise money, so they go out and talk to a bunch of different VC funds, and they end up with a term sheet that they get accepted from a firm called Gray Havens Capital. Gray Havens in the term sheet, and Marc will talk more about term sheets later, but in that term sheet, they assign a pre-money valuation for BioStar Biotech of $20 million. So they tell BioStar Biotech, hey, we think you're worth $20 million today, and we're going to invest $8 million. So some questions. So what is the post-money valuation? What percent of the company does Gray Havens Capital own? What was the share price? And how many shares were issued to Gray Havens Capital after they invested the $8 million? So we'll kind of go through each of those now and give you a sense for how we calculate each of these items. So post-money valuation, we talked about earlier, this is just the invested dollars plus what the pre-money valuation that was decided upon was. So we know that they were investing, Gray Havens was investing $8 million, and the pre-money that they gave the company was $20 million. So the post-money valuation would be $28 million. So what's the share price? So share price can be calculated by dividing the pre-money valuation divided by the number of pre-money shares in the company. And so we told you that the pre-money valuation was 20, and that the number of shares in the company split amongst the founders was 25 million and 25 million, so 50 million total. And when you do that division, you get 40 cents per share. How many shares were issued new that Gray Havens was able to get for their $8 million investment? So they invested 8 million, and you just divide that by the number of the share price. And then that gives you the number of shares. So, Gray Havens got 20 million shares. And so how much of the company does Gray Havens own now? Well, we know that they got $20 million shares. We just calculated that. And if we divide that by the total number of shares outstanding, which was the 50 million shares initially, and then the 20 million new shares that Gray Havens got, we get 20 million divided by 70 million. And that means Gray Havens will own just under 30% of the company. But going back up to the top, there's different ways to calculate these things with different numbers. So just as an example, if you take the another way to get post-money valuation is you take the $8 million you're investing divided by the percentage of the company you're going to own for the $8 million. And, you can, as a gut check, okay, $28 million post-money valuation. So one thing you can think about, with that second calculation that I just showed is that, if I say I'm going to invest, $10 million and I want to own 20%, you can do 10 million divided by 20%. And, you can calculate what the post-money valuation is that you would need to own 20% for your $10 million. So, okay, so now that we've kind of level set on terms and how to calculate some of them, let's talk a little bit more about the belief around valuations and how to get to a valuation that, both VCs and the entrepreneur and the company might be having. So there's this belief, that some folks have that VCs want to drive just the lowest possible valuation because that means they would own the most of the company. And entrepreneurs by default want the highest valuation because they can retain most of the ownership in the company. But generally, that's not true. So VCs don't necessarily want the lowest maximum possible valuation because then they'd be diluting the entrepreneurs, completely out of the company, or maybe even the founders completely out of the company. And oftentimes we want the entrepreneurs obviously to be very, very engaged, that we want them incentivized. And we often want the scientific founders to be very engaged and incentivized, to want to help the company and basically to achieve their milestones. So, VCs don't want to just dilute everyone out who's already there. On the other hand, the entrepreneurs, if they set too high of a valuation expectation, or they accept a term sheet at too high of a valuation, well, the expectation for your investors is that the next round is going to be even higher. Well, that might be very hard to achieve if, this round's valuation was too high. So you want to set, maybe a reasonable valuation, and you set that to reasonable milestones where that you can believe that in success or achieving new milestones, you'll be able to raise the next round at a higher valuation, keeping your investors very happy. So in the end, both parties really do want to set some reasonable milestones and a valuation that makes sense for everyone. So let's talk about, just a valuation heuristic. So how do we come up with what a good valuation is? The way I most like to talk about this is to work backwards. So the most important thing one can do is determine what the business is worth in success. And so when I say work backwards, you work backwards from what the exit value is, and then work back to what the value would be today. So let's assume there's a $10 million, a company's going to raise $10 million. What is a reasonable pre-money valuation for that company? So on the top line, if we assume or we believe that the company in success, when it achieves its milestones, could sell itself for $200 million to an acquirer, and we assume that most VCs, for the risk they're taking, want to return somewhere between 5 to 10x multiple on their invested capital. If you just work backwards and you divide 200 by 10 or by 5, you get somewhere between a $20 to $40 million post-money valuation. Well, that's post-money. Now let's subtract the $10 million that's going to go into the company to get a pre-money. That leaves you with a $10 to $30 million pre-money that a VC might be comfortable with if they're going to invest $10 million, and they believe that given the risk that they need to achieve somewhere between a 5 and 10x return on that money. It's also highly predicated on the fact that we all agree, both the entrepreneur and the investor agree that, yes, in success, this company is worth $200 million. So in the bottom, if the entrepreneur believed, no, my company is a $50 million free, there may not be alignment then with the investor for them to be able to get a 5 to 10x. So really the important thing in the end is to agree on what's the company worth in success. If there's a misalignment there, the investor believes the company's worth 200 million, but the entrepreneur believes the company's worth $1 billion in success. You can see how it would be very hard to align on what a reasonable valuation would be for the company today, such that the investor, given the risk profile in the company, might achieve, 5 to 10x. Generally for less risky investments, we might be comfortable with a 3x return on our invested capital if it was a later stage company. But for most early stage, seed stage, or Series A, kind of stage companies, there's often a lot of risk still left in the business before they would get to that exit valuation. So 5 to 10x tends to be the typical heuristic that investors would use for that. And just to caveat this, this is a highly simplified example because things like prior ownership, future financings that would dilute the investor here and make it harder for them to achieve their 5 to 10x. Other things like additional options being added to the option pool can all affect ownership, can all affect return multiples. So again, it's a heuristic, it's highly simplified, but it's one way to really think about valuation is that if you can agree on what the business is worth in success, it's much easier to then work backwards and say, okay, I agree it's worth this in success. There's a lot of risk. I get that you need to get somewhere between 5 and 10x return on your capital. Here's the range of valuations that make sense. And you start to be able to kind of, both sides can sort of act rational around what a reasonable return might be and what a reasonable valuation would be today. So in addition to sort of just the numbers, there's a whole bunch of other considerations that we can take when we think about what, a company is worth. So, team, how much does the team need to own to incentivize the team? Similar for founders. How much money do we need to raise? Is there going to be a lot more capital that needs to be raised in the Series B or the Series C to be able to achieve the ultimate exit valuation? How much money do you need to even achieve the milestones for this round to be able to show significant growth or just really de-risk the company such that a new investor will view it as a more valuable business given there's less risk in the company? And if there's less risk in the company, going back to our valuation heuristic, maybe they only think they need 3 to 5x return on their capital, given there's less risk. And so again, if you only need a 3 to 5x return, you can see how higher valuations can be acceptable to that investor, even if we still think the business is worth 200 million in success. Comparable companies is another way investors think about valuing companies. So are there any businesses that have raised money in the last couple of years that are really similar? What was their valuation? We also do comparables for thinking about the exit value. So hey, if 3 other companies in that same area or that same sector over the last 10 years have been acquired for X amount of dollars, we might peg your company towards that X number in terms of what it's worth. And then, investors' perspective, how long might it take to get to an exit? If it's going to take a lot longer, we might say, we need a little bit higher multiple or return on our invested capital. And then honestly, we'll kind of think about, well, who's going to buy this company anyways? Is it even reasonable to believe that a company like that would pay $1 billion for this company? If the natural acquirer is a public company with $150 million in cash at any one time, well, it's hard to believe that they can spend $1 billion acquiring something. So, kind of thinking through, what are the realistic expectations and who might buy it is important. There's some other kind of considerations to think about. Another heuristic VCs use will be ownership, and you might hear this a lot. A VC says, when we invest, we want to own at least 20% of your company. That's our heuristic. That's what we use. We want to own 20%. It's a totally valid way of thinking about things, but just you have to understand, well, what does that mean for valuation, and what does that mean for the size of the round that investor might be even willing to invest in? So here's a pie chart example. So a VC who likes to own 20% of the business after they invest, but their typical investment size is $10 million. That's their typical check. They like to invest $10 million, and they like to own 20% of that. That's their internal heuristic. That means what's the potential post-money valuation? So $10 million investment divided by 20% ownership. Post-money valuation is $50 million. That means if you were to set a pre-money of 0, which is unrealistic because that means management owns nothing, the maximum round size for that VC to own 20% of the company investing a $10 million check is $50 million. And again, that's totally unrealistic because it leaves nothing for the management team or anyone else to own anything. So, if you come across a VC whose heuristic is we like to own 20%, our typical check size is 10 million, well, you can't go raise a $75 million round and expect them to invest. They're just not going to. It doesn't fit their kind of worldview of what they like. So you can see how that changes if there's a VC who likes to own 20%, but their check size is $50 million. You can do the same math and say, okay, well, now the post-money valuation is 250. So max round size, at a pre of 0 is 250. So, the larger check writers who want to own 20%, well, they might still also peg themselves to a 20% ownership, but, if they write larger checks, they can now support investing in much larger rounds. So let's kind of give you a quick summary here of kind of some of the things we went through here. So how is pre-money valuation derived? So simple answer, we work backwards. First, we agree what's the outcome look like in success, and then we determine, okay, what's a fair return? 3x, 5x, 10x, and that's all based on what's the risk of achieving that exit valuation in the end. How do VCs and the company come to agreement on a pre-money valuation? Well, that's a simple process. I mean, it's a negotiation for sure, but the negotiation can be made easier if both sides, again, can agree on what the company is worth in success. One of the biggest challenges I think a VC and a company have in getting to alignment is just simply agreeing on what's this worth in success, but also how much risk is remaining. And of course, that always assumes that both sides are acting rationally in how they think about what's fair. And so often a question we get, well, who proposes the valuation? Who sets that number? Does the company propose what they think their company is worth? Kind of like Shark Tank style. I want to raise $5 million and I'm willing to give up 10% of my business, right? Which implies a valuation because now we kind of all learned the math and how you do the division to come up with the pre-money and post-money. Or does the VC suggest here's what the valuation is? And the answer is it's complicated. The company under confidentiality agreements usually disclose what maybe the last round post-money valuation was. If you're raising a round and they already did a seed and it was valued and it wasn't a convertible note, and they said, well, our last valuation was $20 million. Okay, well, now you know, okay, the last valuation was $20 million. They've made a lot of progress. The company probably, and the existing investors probably want to step up. Let's think about if there's room. Is there room for a step up so that we can still maybe get our 5 to 10x that we think we need for our investment? Also, as VCs become more and more interested in the company and we go through our diligence process and talk to you about the technology and get to know the team, we might begin to broach that topic with the company and just get a sense for what are the expectations around valuation. It gives us a sense for how the company's thinking about it. And then often even before a term sheet comes, and Marc's going to talk about term sheets here in a few minutes, both sides will have a range that they've discussed. We've said, yeah, we think, the pre-money might be in this range, and the company might say, we think the pre-money should be in this range. And hopefully there's a good Venn diagram or there's some overlap there. But sometimes a term sheet might just come to a company and it's a total surprise to the company. They didn't expect a term sheet to come. They've never talked to the investor about valuation at all, but the investor, just sends them a term sheet and proposes a number. And again, it's a negotiation. It comes back to that. It's a negotiation. And again, if you can kind of agree on what's this thing, what's the business worth and success, it makes a lot of the other discussion points around what's a fair valuation, just much easier. So I promised to end on some trends on what's been going in the market now. So the first slide is life science valuation trends, and this is specifically for university spinouts. The bars represent median valuations. The red dots represent mean valuations. They're higher because there are always outliers that are at much higher valuations that'll pull those means up. And we've broken this up into seed, early stage, and later stage. This is based on PitchBook data. Early stage, PitchBook defines sort of specifically as usually Series A or Series B financings, and all investments that have occurred within the first 5 years of the company being founded. So that's how they define early stage here as well. Later stage is usually Series B and later, and they all investments that have occurred more than 5 years from the company's initial founding. So what you can kind of notice in the data for sure is that valuations have increased in the last 5 years. Seed stage valuations have gone up. Early stage valuations in life sciences have gone up. Later stage valuations in life sciences have gone up. So across the board, valuations have gotten higher. But I did have Nabil Ullah, our analyst, kind of do a second order analysis here, and I asked him, well, okay, valuations have gone up, but what has happened to round sizes? And we're not showing the data here, and we'll probably show it on our Financing Trends webinar. But round sizes have also gone up just as quickly as valuations. So we talked earlier about ownership, and ownership when a VC makes investment is related to dilution. If a VC owns part of the company, well, there's only 100% of the pie, so that means someone else owns less. And so if round sizes go up along with valuations, that means the dilution to the existing investors or to the initial business owners has remained relatively constant. So while rounds have gone up and valuations have gone up, the overall dilution impact has stayed relatively the same. And but past results don't necessarily predict future performance, much like past valuations don't predict what's going to happen in the future. Perhaps this number in 2023 will go down. We'll see, and look forward to sharing that data in the future with everyone. To talk about tech, so we just talked about life science. Now this is the tech slide. Somewhat similar story. Seed, early stage valuations have gone up. Interestingly, later stage valuations in 2022 went down slightly from 2021, although still higher than 18, 19, and 20. So is this a bit of a correction on the tech side of things? We've heard a lot about corrections in the tech market over the last year or so, or is this simply a blip? And 2023 is gonna we're gonna find something more similar to 2021, 2023. We'll see. I think Marc and I have our own expectations for what we might be seeing going forward. We do believe there's going to be a valuation reset, and especially for some of these later stage companies, they're going to have to kind of come back down to earth a little bit on valuations. But we could be wrong. Remains to be seen. So that's it for the valuation section, unless we have additional questions before we get.
We have a lot of questions, so we'll get to some of those now. So one of the questions, and we've had this asked in a couple of forms, is what is pre-money valuation when a company is first founded, or if there's a founder investment or family round, is there a pre-money valuation, or is there something that's considered pre-money, or is pre-money only really thought about after when there's a proposed angel or VC investment?
Yeah, so it's a great question. So let me start with the sort of the friends and family, the pre-seed or the pre-seed rounds. It's rare we see them get priced. Usually they're in some form of convertible note, meaning that we don't try to price the company today. We just say, we're going to invest the money. It's a debt instrument sometimes it's a safe instrument, which is not truly debt. And our money, our investment will convert at some discount to the next round's valuation. Often it's 20%. So often, I'll get a 20% discount to the next round valuation. So the really, 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 really early rounds, often small, friends and family, tend to not be priced. But then the other kind of key question you asked was, now I'm drawing a blank. Can you repeat? Sorry, Kirsten, can you repeat?
Yeah, I kind of paraphrased, but it was about, your founders, like when you originally found the company, and then you have your friends and family / maybe those really early stage investments.
Yeah. So does it matter? Like, do you need to value a company when you first found it? Not really. I mean, you could say the company's worth $1. You could say, hey, there's 2 founders and we're going to split it equally, which we have other talks where we talk about that's not always the right thing to do. And please look for our talks on founders equity on YouTube because we get really into this topic. But you might just, for simplicity, we'll just say, yeah, we're each going to take half, and we're going to create 2 shares. You get 1 share, I get the other share. We each own 50% of the business, and we value the company at 1 penny. Like, it really doesn't matter what the company's worth when you first found it. What really matters is, when you have proposed investment dollars, what valuation those investment dollars are going to go in at. So that's really when it matters. From my perspective, valuing a company initially doesn't make a lot of sense. And in fact, if you value a company initially, and you grant options and you do other things, like you may run into some IRS tax implications. I'm not a tax accountant, but consult your attorney and your tax accountant as well, because there could be other implications to think about there.
Great. So another question. So when we were looking at that, potential exit value of the deal down the road and how to get there, the question is around, isn't that multiple to try to get to that exit amount highly dependent on the industry and market, but also market conditions, and how much are VCs arguing today about multiple assumptions that play out in 5 to 7 years, which you don't know how those are gonna work? Do you just kind of make certain assumptions of how the market's going to go?
I might let Marc answer, because I think the question is about multiples, perhaps on revenue, but it might also be multiples on our invested dollars. But I'm going to let Marc take that first part.
Yeah, and I think this actually applies both to tech, where you can have specific revenue multiples, but also life science, where it's harder on a multiple basis, other than like a multiple peak revenue potential, for example. You are right. The question is right, that when we are valuing a company today, we are trying to estimate what we think it will be worth down the road, 5 years, 7 years, maybe even longer. And we do not know the market conditions in that far down the road. Nobody does. So what we do as investors is basically use kind of market medians. And we assume we are going to be in a normal market, not a frothy market, not a bear market, an average market. And there's lots of data around there, like a phase 2B life science company in oncology, what that would be worth in a normal market, or you can build your data set around that. Similarly, for a cybersecurity company generating 100 million of ARR, and you can figure out what software multiples are, the kind of median software multiples. So that's how we're valuing it, is assuming normal market conditions based on a normalized data set. Generally, we're also assuming that these companies are bought, not that they go public. they might in fact go public, but the public markets are fickle. They open and close, so you don't know if that will be available. So our starting assumption is to assume that it's an M&A transaction at an M&A multiple. And then if the public markets happen to be open and it's worth doing, we'll do that.
Great, thanks. I'm going to ask a couple more of these kind of early stage pre-money valuation questions. So this question is about grant money. Does grant money then at the beginning, in addition to perhaps friends and family money, et cetera, add to your pre-money valuation of the company?
It does not. It does not. And grants are great. They can be great for companies, but if a company tells me we've raised $20 million, I hope I don't want to hear, well, 19 of that has been in grants and we actually raised $1 million, right? If you're going to sort of show, how much the company has raised and you want to include grants, I'd highly recommend you break it out. Say, we've raised $5 million in equity, $15 million in grants. And I think a lot of companies would like to get credit for their grants. Well, we have $20 million going in this company. How could the company be worth less than $20 million? Well, grants are given not based on a return on invested dollars. And so if you're going after a market where the ultimate acquisition is $100 million for your company, and I think there's 10x worth of risk in getting to that $100 million, $20 million starting valuation, is not going to make sense. So again, it comes back to that heuristic and working backwards. If you've got 15 million in grants and, so in total it's $20 million of dollars that have gone into the company, but the company's worth $5 billion in success, doesn't matter, right? Like I can take your grants into account or not, there's plenty of room for an interesting valuation for me for my return on invested dollars. So it just really comes back to that heuristic and thinking through it that way.
Other than that, the one thing I would add to that is if the grant enables you to get to another value creating milestone, so now you've de-risked the company, then your comparable data set of other companies that raise capital at your stage has changed. So if you apply the grant money wisely and advance the value of the company, it can, through kind of the progression of the company, improve your valuation.
So next question is about to what extent is pre-money valuation dependent on future potential if the company has no revenue yet, which is the case for most of those biotech companies, for example, Marc.
Yeah. So biotech companies almost never have revenue, right? We're investing in companies, and usually we're exiting the companies before they ever have revenue too, right? So it's like a perpetually never revenue investment. So Marc kind of alluded to this earlier. One of the ways you can think about it is, what's the potential revenue for the product once it is, on the market. And, as companies move into the clinic and our clinical stage and get through phase 1 and phase 2, they start to build revenue forecasts. And you can build NPV models based on those revenue forecasts, And so you can get very technical, MBA style and think about valuation that way. But typically when companies are really, really, really early and they're really preclinical, it's kind of a garbage in, garbage out situation if you try to build a revenue forecast in an NPV model. It's just too early to do that. And so again, with valuation, we really focus on, well, what do we think an acquirer might pay? And oftentimes we'll do comparables analysis and say, okay, well, companies with a phase 2 proof of concept data in hand in cardiovascular disease, I found 10 comps. They were acquired upfront for this, milestone payments of this, earnouts. All right, let me see, okay, let me apply that exit valuation to this company I'm looking at, work backwards. There's early preclinical, want to at least be able to see an 8 to 10x return. What is a reasonable valuation on that? And so when you don't have revenue, you can't do revenue multiples. When it's really, really early, you typically don't want to try to build a revenue forecast for a product that might be more than 15 years away from hitting the market. So you kind of look at comparable companies, what were acquirers willing to pay recently for companies that had, operating in similar therapeutic areas with, at a similar stage, after phase 1, after phase 2, after phase 3.
Great. At what amount of the seed or pre-seed round should a company move away from notes or safes?
Like size of the investment, yeah.
Yeah.
I don't know, Marc and I may have even differing opinions.
Different answers on this, right?
It's a bit of an art, right? Like, I don't think there's an exact number or science to like how you determine that. It's, you know, I've seen some crazy convertible notes. I've seen convertible notes of $50 million for some biotech companies before, for clinical stage biotech. So I've seen some wild things. You know, I think when you start to get above, you know, $5 to $10 million, I think that's when you really need to start thinking about pricing something. I don't know, Mark, if you disagree.
Yeah, I would have said 5, so in the same range. I would call out the problem is that in a SAFE or a convertible note, the investors and the company are misaligned. Whereas the company, it wants to drive as high a valuation in the next round as possible. The investors don't, because they've just given you money that enable that future high valuation, and they wind up effectively converting at that price and paying that price. So it winds up, you have misalignment and to some degree, a lack of fairness to the investors if the SAFE is too large and you go 2 years or 3 years and then raise capital at a very high price when you have all these SAFE investors who took a tremendous amount of risk investing very early. So that's why in general, it's better to keep it smaller and keep everybody aligned.
All right, I don't want to go too much off topic here. Next question, and so just to let everyone know, we often run long in our webinars because we get so many terrific questions in. If we do go over the hour, which I'm guessing we will at this point, we will keep recording. This will be available afterwards, as we said before, on the YouTube and as well as on our partner portal. So apologize ahead of time if we go over, but these are really great questions. Next question is, what level of equity held by passive founders, faculty staying at the university, for example, and not involved in running the company, would start to negatively impact valuation or even prevent a financing? And the questioner is asking, let's assume that's at a Series A stage. Is there a level that would actually negatively impact valuation? Matt.
Okay, called on me. Yeah, I can start. So certainly above 50%, right? Like if you know, let's say the academic institution owns, not the founders, not the academics, but let's say the academic institution that takes 60% of the company at founding, it might be tough only because the academics themselves, which we're trying to incentivize to be involved in the company, may not own enough. And then when we raise money, they're going to get diluted down to nothing. And that could be really hard. And there might not be enough for everyone. And the management team we have to recruit and everything like that. But I would say that, it's typically not a problem, at least in biotech. The amount of capital in biotech that needs to be raised over time is hundreds of millions of dollars. The management team is almost always diluted out. And so we have to keep issuing new options so that the management team ends up owning somewhere between 10 and 20% of the company, always. We always kind of re-up the management team with new options. The academic founders, often can be diluted down to very, very small amounts if they're not involved at all anymore. Because the nature of a biotech company is we just need to raise a lot of money, and that's very diluted. But sometimes those academic founders are still very involved. They might be on a scientific advisory board. They might be advising the company in other ways. Oftentimes they're advisory agreements where they might be actually getting cash, a yearly stipend. But also they might get some of those new options that are created to incentivize them going forward. So at least for biotech, it's usually not too big of a deal, but that might be different in tech. So, Marc might want to comment.
No, I think it's similar in tech.
Okay. Great. Well, so we'll head on to the term sheets. We know we have a number of other questions that are remaining. We'll finish our term sheets parts, and then we'll get to the remainder of the questions. Marc.
Great. So now that Matt hit valuation, that is the most critical component of a term sheet, but not the only component. And so what we'll do is connect that into an actual term sheet for investment and go over both how the valuation itself is reflected in a term sheet, but then also how some of the other features that you should expect to see when you're raising capital and receive one or more term sheets. So first, all right, so first kind of a hit, what is a term sheet? And a term sheet is a document that is generally prepared by the investor. So usually a venture capital firm will always submit their own term sheet to a company. It's rarely created by a startup themselves, except in some angel and kind of early angel situations. Sometimes it is where there's not one larger investor, but generally it's created by the investor, designed to lay out all of the key terms of an investment. This includes both the valuation and the size of the round, but also other features as well. And it's designed to get everybody on the same page in the middle of the process, so there aren't any, so if there are any disagreements, they can work them out then. And so it kind of lays out all the key provisions of an investment. Usually, well, most of those terms are non-binding. So a term sheet itself is in fact a non-binding document. And over on the right, you'll see just a picture of a term sheet. Usually in the first paragraph, it says explicitly, this is a non-binding document, except for what's called a no-shop provision or an exclusivity provision. It says that if you sign the term sheet, then you're committed to just work with that investor exclusively to close the investment. You don't have to close it. You don't have to ultimately stick with these terms, but you can't work with other investors at the same time once you sign a term sheet. So the exclusivity provision is the one piece of it that is generally binding. Most term sheets in the venture capital world start with some form of the NVCA model documents. The NVCA stands for, is basically the National Venture Capital Association. It represents venture capital firms. And many years ago, they did something very smart, which is to create a representative set of documents that all VCs and startups could use. It includes both a term sheet. So if you go to the URL that's listed here, you can actually find the NVCA term sheet, which includes all the different permutations you could put in a term sheet and other legal documents as well. So it's helped create standardization, improve efficiency in the marketplace. And the final piece is kind of when does the term sheet come? And I'll start by answering a question that actually came in advance of the webinar of how long does it take for a company to get a term sheet on average? And we're in a much slower market today than we were a year ago. I would say in today's market, the average is somewhere between 6 and 9 months with a range. It takes a long time to get a term sheet. It very much depends on the quality of the company and the team. But if you're an entrepreneur raising capital, you should assume it's going to be 9 months and assume a long process. And you want to build that in so you don't run out of money early planning on a 3-month process when it really takes 9 months. So we tell our companies to plan on 9 months really till closing. Now the term sheet will come towards the end of that, but not at the very end of it. But assume it'll be 6 to 9 months to a term sheet. Then in terms of if you're engaged with an investor, usually the term sheet will come after most of the business diligence is done. And that's what, for both an investor and the company, you want. And if you're a company raising capital, you want the investor to be serious about their terms, to have done most of their diligence so there are no surprises later that would have them to rethink whether they want to do the deal or the valuation. So you want them done with their business due diligence, and the investor generally wants the same. So usually once you have the term sheet, after that, most of the rest of the process is legal diligence, legal documentation, perhaps bringing in other additional investors. And so a closing of the actual transaction usually occurs 45 to 90 days after the signing of the term sheet. So then, so now I'm going to go into some of the details of the term sheet. Over on the right, you see kind of a picture of a sample term sheet from OUP. This is fictitious. And then at the top, you'll see what the actual language in the term sheet looks like. So the first thing is how much capital does this term sheet call for in terms of the size of the raise, and also who is putting in that money. And so, and Matt went through a bunch of permutations of this on the valuation side. So the first question is, what's the right amount? This term sheet has it being an $8 million round, and as a company, you've got to decide, is that the right amount? Usually that amount comes from the company saying, we need a certain amount of money. And in most cases, the investors will agree with that and then mirror that in their term sheet. Sometimes they may disagree because they either think you need more or less given what the company is doing. It also may increase or decrease based on the specific needs of that investor. Then this general part of the term sheet, we'll also talk about how much the lead investor is putting in and how much is expected from other investors. So in this sample term sheet, OUP is putting in $4 million of the 8. You generally want to make sure your lead investor who is setting the terms is putting in a fairly significant part of the round. That's usually about half the round. It could be as much as the full round. Every once in a while, it might be a quarter of the round. And then the question is like, who else is investing? Sometimes in some rounds, it's just the lead investor and then the existing investors. Sometimes you'll bring in other new investors. In life science companies, you almost always bring in multiple other new investors at the same time alongside a lead investor. So the sizing will lay all of that out. So then when you have that, you then go through, the next piece is like, what's the valuation? And Matt went through all of the calculations around the valuation. Here you would see in writing what the investor is valuing the company at. In this case, you can see at the top, they're valuing the company at $16 million pre and a $24 million post because it's an $8 million round. And then you go through, when you have this, you go through all the calculations Matt went through earlier of what's the share price and how much dilution is there, and all of that math falls out of this. So in this case, we have 8 million and a 16 million pre a $24 million post. That 8 million is buying 1/3 of the business, and then you could calculate the dilution that comes from that. So if you were a founder and you own 25% of the business, you'll be diluted by 1/3, and that would bring you down to 16.7% of the company. So that's the starting point around the dilution math, but that's not everything because of something Matt mentioned earlier, which is what happens in options. So you'll see in the top section, in the second sentence, it says the pre-money valuation shall include all employee options, whether granted or ungranted, and the options pool becomes an important point here. So to drill into that, there is often another section of a term sheet called here additional employee options, where the investor is saying immediately prior to closing, we want you to increase the size of your option pool because we want you to have more options that you can issue to your current and future management team members. The rationale for that from an investor standpoint is they generally want to invest in companies that have complete management teams. But we all know that management teams aren't complete in the early stages. But an investor doesn't want to both take the risk of building the management team and the dilution attached to building the management team. So what they try to do is push the dilution part of building a management team more to the existing shareholders. So what they will do is increase the size of the option pool. In this case, the language basically says that they're increasing the option pool by 6%, such that the unallocated option pool after this round is 12.5%. So you have a lot of options to give out to future members, but they are pushing that into the pre-money valuation. And that's where in the highlighted section, the words immediately prior to closing. What the term sheet is saying is right before you take in the new money, you have to issue new shares, and those new shares only dilute the existing investors. They don't dilute the new investors. And that's the way new investors try to control for the dilution around this. And most venture capital term sheets are structured this way, where the new options go into the pre-money, not into the post-money. So they dilute the existing shareholders and not the new shareholders. Sometimes that can be a negotiation point, and sometimes it can be put in the post-money, or it can be a blend, but usually it's in the pre-money. So then to go through kind of the dilution math on that, I'm just going to jump to the number at the very bottom line of the bullets. Now, if you put in the additional option dilution, that founder who originally went to 16.7% from the dilution of the round actually goes to 15.6% because they do suffer more dilution from the pool. Obviously, that the pool is designed to build a great team and make the company more successful, but you need to understand the dilution math of the employee option pool. This is often a big sticking point in a big negotiation in a term sheet. All right, so now I'm going to move on to other less directly financial components of a term sheet, but terms that still matter. So the next term that matters is either the liquidation preference or preference stock. And what a liquidation preference states is that an investor who's investing, they will be buying preferred stock rather than just common stock. Usually founders own common stock, investors buy preferred stock, which give them a series of extra rights, in particular the liquidation preference. And what the liquidation preference states is that in a bad outcome, where you're not selling the company for a lot of money, the investor has the option of getting their investment capital out first. So in this case, if the investors invested $8 million in a Series A preferred round, and you sold the company only for $8 million down the road, the investors would get all $8 million. They get their capital back. Rather, now they may own a third of the business, but they, instead of taking a third of the $8 million, they can get all $8 million. So what it does is it provides downside protection for investors. And in most cases, it's structured the way I described it, where there is what's called a 1x non-participating preferred, meaning the investors can get 1 times their money back, or they have the option to convert to common and get their percentage of the total proceeds. And it provides downside protection. That's the way most of these deals are done. It's fairly normal. And as an entrepreneur that's focused on building a successful business, they generally think we're not gonna have this failure situation, and so it shouldn't. There are other variations of preferences that you will see in term sheets. The most common one is something called a participating preferred, where the investor can get their capital back and participate in the equity proceeds as if they converted to common. So in that case, they're effectively double dipping. They get that downside protection, they get their $8 million back, but they also get a third of the remainder. And so what that really is a sweetener for investors to improve their returns. Sometimes you see this when an investor is paying what they feel is a higher valuation that perhaps makes them feel a little uncomfortable, and they'll put in a participating preferred to try to improve their payout. You'll also see it in lots of other situations as well. Some life science deals have this, and there are different kind of variations of it, but it's in some deals, but not all deals. It is investor friendly, generally not founder friendly. And then also the multiple itself can change. So sometimes you will see a 2x participating preferred or a 2x non-participating preferred, where the investor can get twice their money back on the downside. That's usually only in troubled situations, as opposed to a company doing well, just raising a typical financing round. So then the next part of the term sheet that matters is the board of directors. And so a term sheet will state what they think the new investor thinks the board of directors should be. Sometimes it's just no change to the board of directors, but in most cases, the lead venture investor wants to be on the board. And so what that does is it forces everybody to think, what's the right structure of the board? How many board members should we have? And also, who should be on that board? And usually, a good board has 5 to 7 members over time. If it's too small, often you're not getting enough good input at the board level. If it's too large, then it's just an unwieldy group. So we generally prefer kind of 5 to 7 member boards. And usually you want the board membership to match the equity ownership. So if you have, you've raised 2 rounds of capital and you have investors that own 40% of the company, you would generally want investors to have 40% of the board. So in a 5-person board, that would be 2 of 5 board members. So usually there's a rough match between equity ownership and board membership. If a founder owns 20% of a company, they would have 1 board seat. But you also, in a board, you want to be thoughtful about guiding the company. So the board is a great opportunity to pull in outside perspectives and outside experiences that can help drive a company to success. So you also want to make sure you have a range of voices and experiences at the board level. So in my experience, boards that are all very investor heavy do not wind up being great boards, or very founder heavy do not wind up being great boards. So you really want a mix of founders and the management team, investors, and also industry outsiders. And outsiders in particular bring a different, fresh set of perspectives. So it's something to be thoughtful about. At each new financing round, it's a chance to say, do we have the right board? Should we change it? Investors will often step on a board for a while and then step off. And so it's a chance to make sure you optimize your board.
And Marc, I'm just going to put a point in here that we are going to have a whole session on boards in our July or August webinar. Great.
Thanks for pointing that out. Then there's some other more detailed provisions I'll just quickly hit. One of the things to be thoughtful about are what are all the voting and protective provisions. Usually these come in a term sheet, but not always. Some venture investors don't cover this in a term sheet, but they're in the legal documents. And the things to think about are, one, there are a series of what are called protective provisions that the investors need to approve for the company to do. So it's designed to give the investors say in the key important strategic matters of the company, such as selling the business, raising capital, raising debt, changing the board. So there are a series of things that you will need to get investor approval. They're generally fairly reasonable. The M&A piece is the one like you want to give thought to, because what you don't want to do is give one investor a veto right unless they own a very large percentage of the business. So you've got to be thoughtful about how these work. And then, at the bottom of the slide, there are a couple of important concepts to think about. One is, how do people vote? So over time, a company will wind up having multiple classes of preferred, a Series A, a Series B, a Series C. You generally want them to vote together as a single class of preferred. And the reason why is that it reduces the risk that any one investor can have a veto right. And so usually it's in the company's interest to see them vote together, and actually in the investor's interest also. And then the second thing to pay attention to are there are usually voting hurdles to say, to approve kind of an M&A event or stock issuance, you need the approval of 60% of the preferred votes, or 50% or 70%. And you want to be thoughtful about how that percentage is set, so such that a reasonable group of investors can approve it. Nobody gets hold-up value over the company. So you ultimately wind up modeling out different scenarios of approvals and make sure that it's just a fair hurdle. So then quickly, there's another section in the term sheet called anti-dilution protection, which is not what it sounds like. So this does not actually protect an investor against dilution. If an investor owns 20% of a company and the company goes and raises another round at any price, that investor is going to get diluted. What this does is it protects the investor if you raise money in the future at a lower price than what the investor paid. So if the investor paid $1 a share for Series A, and then you go raise a Series B at 60 cents a share, it gives the investor additional shares to try to protect themselves against that excess dilution that came from raising money at a lower price. There are two ways it is generally done. One is called a full ratchet, where you actually retroactively change the price the investor paid from $1 a share to the 60 cents a share. So it's as if they paid the lower price later. That is the most investor friendly, the least company friendly, also not that common in the market. The more common approach is what's called a weighted average, which is a very detailed calculation that in legal documents often takes a page or two, that just tries to create a weighted average between the two prices. And it's a mathematical formula that gives the investor some protection, but not as much as what a full ratchet would do. So then finally, there's some other key terms I'll just call out without going into detail. One, dividends. Sometimes you see dividends in term sheets. They've been disappearing a lot. Dividends are never paid out in cash each year. So they accrue and they're paid out at a liquidation event. But often you don't see them. And if you do see it, the key question is it cumulative, in which case it's basically accrues every year, or non-cumulative, which means it only accrues in the year you actually have an exit event. But again, they've mostly been disappearing. There are also follow-on investment rights or preemptive rights. These have similarities to the participation rights our universities have in their license agreements, but they are a little bit different. But these allow, in particular, the major investors to be able to participate in future financings of the companies that they own shares in. Usually there's a target closing date. Sometimes it's aspirational, 30 days from the signing of the term sheet. There's also an expense clause that says that the company will pay the investor's legal expense, and that's pretty normal, but you only want to pay it for one investor. So if you have 3 new investors, generally you only want to pay the expenses for the lead investor. And then there's a no-shop provision, which is what I mentioned at the beginning. This is the one section of a term sheet that's binding that says that if you sign this, you can't go negotiate terms with other investors and try to use this term sheet to get better terms somewhere else. So once we agree on these terms and you sign it, then we are committed to working together in good faith to try to close the financing round. But again, there's no obligation on closing the round. So the last piece I would hit is kind of, what do you do when you get one of these term sheets? And the key is this is like, you need to be thoughtful, read it, get advice, but it can be negotiated. And a lot of these terms be negotiated. I would encourage you to focus on the things that matter and not everything. When you focus on everything, then these negotiations just take too long. But also don't only focus on valuation. There are many other factors that matter, in particular the quality of the investor. Are you aligned with them? Can they help you? And you do see companies take lower valuations from better investors rather than higher valuations from an investor they don't like. So think about the investor first, the term second. So with that, Kirsten, I'm going to turn it back to you and we can hit some of the questions.
That'd be great. Thanks so much. And we know we're at the hour, everyone. Again, this is being recorded. So if you need to leave, you'll be able to see all of this later. First question to you, Marc. Are there any formulae that evaluate the value of preferred shares versus common shares?
Yeah, there's not a great formula. You could create it where you basically create a series of outcomes, failures and successes, and you'd assign probabilities to each and try to value what the value of like the preference is. What's hard is it's only valuable in the downside scenario and also only valuable in the downside scenario of an M&A event. If you go public, it goes away. So there is not a good formula for like, you could try to figure it out, but there isn't one formula for figuring it out.
Okay, great. And this next question, I think, is partially going to be answered actually in our cap tables webinar, but I'm going to ask it just briefly right now. And is downside protection for the preferred investors negotiated between the investors, or does the company control this? For example, if 2 or more institutional investors have preferred shares, but the sale price doesn't allow all preferred investors to get their 1x return, what typically happens?
Yeah, well, so first, like the company controls it at the term sheet stage, at the negotiation of it. And because usually, in particular, if you're raising a Series A round, the only people, the preferred, the liquidation preference impacts are the common shareholders. And even when you raise a Series B, Series C, the company has a say in what it is, but the investors will also have a say at the time of the financing, not at the time of the exit. So if let's say you're raising a Series C round, it's your 3rd round, the term sheet will actually dictate whether the Series C liquidation preference gets paid before the B and before the A, or do they all get paid pari passu? That happens at the time of the investment, and it's a negotiation such that more common it's pari passu, they're all equal, but sometimes one is senior to another, such that when you get to the exit, it's stated, it's known how you go about paying off these liquidation preferences.
Right. And we will be talking more about that, obviously, in the cap tables webinar that we'll be having in the future. Next question also for you, Marc. Do liquidation preferences apply where shareholders are converting to stock in a new entity, for example, in a SPAC, rather than truly liquidating to cash? And if not, are there other typical provisions for preferred shares that would provide that type of advantage, or in a conversion of shares into shares of another company?
In any situation where you are converting out of your preferred into common shares, which is what happens in an IPO, which is what happens in a SPAC, then you do not, the liquidation preference disappears. You do not get it. The only time you get it is when the shares are not converted, but basically paid out, like they're bought directly, which is an M&A event. So in all the other forms, it disappears.
One more question I'm going to put to you, Marc, and then we're going to go back to the valuation questions. We know people are having to sign off from the hour. We do have a survey that you should fill out if you can. It's very short, but it does help us with all of our webinars and the future webinars that we're going to be having, some of which are actually going to come out of some of the questions I think that we're having today around certain areas. But this question, and I think this more is going to be one that we also answer in other webinars that we have, but very generally, who finds the board and the CEO and how? Like, is there just kind of a general answer you can give on that, or is it very situation specific?
It's very situation specific. So let's start with the CEO. That matters more than anything. who finds the CEO, because the team and then the rest of the team, usually it's the founders that do. Sometimes it's the investor, depending on if it's a seed stage investor that's used to investing in a company and building a team. So it's usually some combination of the founders or the investors, although sometimes it's universities, tech transfer offices that invest in startup business development in other areas, they can as well. So it comes from lots of different places, the CEO. Then whoever are the shareholders will define the initial board, so which would include the CEO and founders and maybe some outsiders. And then when an investor comes in, then they all decide it together. So there are usually many different people who have input in setting up that board. Sometimes at the start, though, it's just the founders before you raise capital. And even at that stage, if you're a founder on the call, I think you should look for outsiders. It doesn't have to be investors. You want people with industry experience.
Great. And Marc, one more question came in on the term sheet side, and then we'll move on to those valuation questions. How much input or feedback should the university as shareholder and licensor expect in the negotiations of a term sheet with VC?
Yeah, the university itself usually has very little say in the term sheet because they're a modest shareholder. Usually the license is done at that point, but it might not be, but usually, often it is. And so unfortunately, they're in a situation where they've got to just accept what's there unless something's being asked of the university. If there's a request of the university, let's say to change a license term or to do something else, that gives the university say in what's going on. But generally, universities don't have a say.
Great. Thank you. We'll move back to some of the valuation questions that we had earlier that we didn't get to. Matt, this is, and maybe this is not, maybe there's just no connection here. If valuations are going up and continue to go up, why are IPOs going down?
I love this question, actually. It's great. So what we showed you were private valuation, private company valuation. I think most people looking at their stock portfolio know that public market valuations have gone down a lot. So because a lot of public market investors are different than private market investors, and those public market investors have lost a lot of money in maybe some risky bets they took, biotech, for example, they pulled out of participating maybe in that sector. Maybe they were more generalist investors that were public investors, and they thought biotech is a great place to deploy capital. And then they lost a lot of money because public market valuations crashed. Maybe they pulled out of investing in that space still. So generally, I believe that public market valuations should have an impact on private valuations. The reality is it takes time. It often takes perhaps sometimes a few years for that to work through, for those public valuation downturns to trickle down into the public market valuation. Because private companies, it's the private market valuations, private companies need to raise another round to be revalued. And a lot of these private companies have raised enough money for 2, 3, 4 years. And so to kind of see this all work through can really, really take some time. But of course, when we see public market companies at lower valuations, those are, again, comparable analyses we might do. We might say, you're the same company working in the same area, and that's in phase 2 or phase 3. The public market says it's worth X. So, in success, when you get there, you might only be worth X. And so, again, the private market valuations just take time to come down, which is earlier why we were commenting, let's see what happens in 2023 and 2024. We do expect, especially on the later stage, to be some correction from some, very high valuations that were given, 2, 3, 4 years ago, where companies will start to run out of runway and have to raise new rounds and be revalued. So, that's my answer. It really has to do with the dynamics that occur between the public market and the private market. And I guess directly going back to the IPO, like why aren't there IPOs, right? Well, if those public market investors are not participating, who is supporting these investments in these large IPO rounds? It's not the private investor. So if they're not participating, there are no IPOs.
Thanks, Matt. Marc, how do you determine the valuation cap in a SAFE or a KISS agreement? Do you look at comps?
Yeah, we do. The cap in a SAFE is, for those of you who don't know what that is, like a SAFE, again, is a vehicle like a convertible note to invest early without pricing the company, and you would convert at a discount to the next round. But they also often have a cap, which is the maximum price you would pay. And that provides some fairness to the investor who's taking earlier risk, that they're not going to overpay in the future. And we generally view the cap to some degree like the maximum value of the company we would be willing to pay today if it were a priced equity round. So we approach the cap in a pretty similar form to a priced equity round, and so we would go through the same approach that Matt described on ultimately valuing the company.
Great, thanks. And then so we had a number of questions on safes, Marc. We're gonna actually probably do a webinar then, just kind of an early stage investment vehicles based on all these questions that came up today. But we're gonna quickly answer a couple of these, but just expect that we will answer these more fully in future webinars. But just generally, how often do VCs use safes, Marc?
Yeah. I don't have data to say how often. They are used in the marketplace. Like, it's a good tool, it's commonplace, and Y Combinator popularized the safe is done a service to the industry. It is done, as Matt said, where it's just early and hard to value the business, and on smaller rounds. So as an investor, I would say that we always have a preference not to do a safe. Like, we prefer to know the price that we are paying, and that helps us to assess the opportunity. In particular, if we're investing a lot of money, we would not do a safe. We also, as an investor, OUP will not do a safe if it's our first investment, if there's not a cap. Because again, we're misaligned, we don't know the price we're paying, and it could be the company goes for 2 years and raises money at a very high price, and we convert into that price. But we wouldn't have chosen to pay that price to begin with. So we won't do safe as a first investment without a cap. But it is a good tool for $5 million or less quick small rounds.
Okay, great. And I'll save the other safe question for when we actually do a webinar on this. Okay, going back to valuation, how does having the IP or tech in hand or not affect the pre-money valuation? For example, the founders have not yet licensed from the university. Where does the university IP owner factor into the pre-money valuation, Matt?
And I want Marc to chime in here as well. I think he'd say the same thing, which is, we don't really value, we don't value the IP separately. When I'm thinking about the pre-money for a company, I don't really splitting out, well, the company is worth X and the IP is worth X, and we have the IP on top. I value the whole company altogether as a business. The IP is protection and freedom to operate. The IP is so that the company can do what they say they're going to do, and that someone isn't going to come in and say, you can't do that because you don't have, you're infringing on our IP. And the IP is, giving them some moat, some competitive advantage, such that they can go execute on their business, and someone isn't going to come in and do the exact same thing and take, half of the potential revenue opportunity away from them. So the IP is a tool that enables what the company will be worth in success. As we talked about, over and over and over again during this conversation, what that company is worth in success is so important when we think about what's the valuation for the business. The IP enables that number to potentially be larger. But it's not something that I would separate out in terms of pre-money. I'm valuing the business as a whole, not the components. I don't know if you have anything to add.
I have nothing to add.
And then kind of going along with that question, is there a preferred model for valuation of IP assets, or is that kind of the answer is it's just not done separately from everything else? Matt,
yeah, I don't have a model.
Was actually for Marc.
I don't know Marc is.
There's no good model for valuation of IP assets. And the truth is, we view IP assets as downside protection. Like, it enables a great business, so it's critical to the founding of the company and the future success. But it's necessary and enabling, but doesn't drive the future value. The future value is driven by the products that the company develops. So when you think about valuing the IP, then it becomes, after the company started, other than like the products it enables, it's really downside protection. If the company doesn't work, can you sell off that IP? It is real downside protection. So in some of our companies that unfortunately did not work, we do wind up getting some money back because you are able to sell off the intellectual property, but it's very difficult to value.
Perfect. Great. Well, I think there were a lot of other questions that kind of revolved around around the exact same areas that we just covered. So if people do have follow-up questions, feel free to email us. We had put our emails at the end of the slides, but you'll receive those as well for all of you who registered. I'd like to thank Marc and Matt for joining us today and answering all these questions. Thanks to all of you, actually, for a bunch of you who stayed on for well after the time that we had originally allotted for this. We really appreciate it. And we also appreciate the other ideas that came in for future webinars based on some of the things that we discussed today. So thank you very much for joining us. And thank you, Marc and Matt, again, for being a part of this today.